In this lecture, I want to talk about the option strategy called the bear put spread. This is basically buying a put spread. But let's begin with a chart of a stock. This is a chart, a monthly chart of Tesla. And you can see that the stock is currently trading around 220, 221.47. And let's say that we're bearish on this stock. And as you probably know from my other videos, I've been quite bearish on Tesla over the past 12 months. Now, if you were thinking that Tesla is going to go to zero over the next 12 months, and it's currently trading about 221. There's a clear way of playing that. And what you would do is you would basically buy, let's say, a slightly out of the money put, buy the 200 put, just go long the put, and then you can ride it all the way down to zero. And your max profit in that case is would be the put option would be worth 200 at expiration if the stock was essentially at zero. So that would be the way if you're extremely bearish on a stock. But let's say, for example, that you'd like to own the 200 put. You'd like to be long the 200 put on Tesla that expires about a year from now. But you think there's some floor to the stock. You don't think it's going to go to zero in spite of their massive debt. You think maybe Microsoft or Apple buys them at 100. So there's some floor that this is not going to go all the way down. And so in exchange for recognizing that floor and saying basically, instead of buying the put at 200 and riding it all the way down to zero, you say, you know what, I'm going to give up some of that potential upside because I don't think it's actually going to go to zero. I think it's just going to go from 200 to 100. And in exchange for giving up some of that upside, it's actually downside, but because we're long the put, we'll make money if the stock falls because being long a put is a bearish strategy. In exchange for giving up some of those profits, you can mitigate or lower the cost of the put premium. That's the basic principle behind it. You want to buy a put spread or be long a bear put spread if you think a stock is going down, but maybe not going down a large amount. So let's turn to our slides here to talk a little bit more about bear put spreads and how they're constructed. Basically, you buy a put option that's normally a strike below where the stock's trading. You can do this, you can really put these on anywhere. This is the typical way of doing it. You buy a put option. So if Tesla's at 220, maybe you buy the 200 put option. And then you sell a put option that has an even lower strike in order to fund your purchase. This is called buying the put spread. It's bearish put spread. Same expiration date for both of these put options that you're long and short, and same underlying security, the same stock, obviously, in this case, Tesla. This is another vertical spread, obviously, because we have the two strike prices stacked. The two strike prices are stacked. It's a bearish vertical spread. You believe the stock will fall, but you don't think it's going to fall maybe as much as you would if you were just long a put option. So in this case, you want the stock, you will maximize your profits if the stock falls all the way down to that short put strike price where you sold the put. And that is the strike price where you're giving up potential profits if the stock moves below that. And your profit is going to be capped by that short put option. But in exchange for giving away some of those profits, you get to partially fund your long put option. So it's a little cheaper than just buying an outright put option. So let's use this example of Tesla. Tesla stock is roughly at 220. We're going to buy the 200 puts. We're going to pay 30.55. We're going to sell a 100 put and collect 570. Both of these options expire next summer, June 19th to 2020, or about 295 days from today. Now this is because we're going long the put spread, there's going to be a net debit involved. We're going to actually have to pay out money. We're not going to be collecting money. And that net debit is just going to be the price we pay for the 200 puts, so 30.55, minus the price we collect from selling the 100 puts, so minus 5.70. That equals 24.85. Again, we're paying money to enter the trade, just as you would pay money to enter to buy a put option. In this case, we're paying money, but we're somewhat funding it. So that net debit of 24.85, if we do it with 10 contracts, we basically buy 10 of the 200 puts and sell 10 of the 100 puts. That would cost us $24,000, $24,850. This is an actual cost to us. The cash will be segregated and held as margin by the broker. Now, the nice thing, just like buying a put, put option, when you buy a put spread, the max loss is just equal to that initial cash outlay, that initial net debit to your account. So in this case, $24,850. Now this will occur if the stock is above that top strike price at expiration. And so in this case, if the stock is at 200, if Tesla is at 200 or above, both of these puts will obviously expire worthless, and we'll lose that net debit that we paid. Now the max gain on a bear put spread is simply the spread, the width of those two strike prices. So in this case, it's 200 minus 100 equals 100. The width is 100. And then we subtract the premium paid. So we paid $24.50. So the max gain will occur if Tesla is trading right at 100 or below. And in that case, the spread will be worth 75. Our max gain will be 75.15. The spread will be worth 100, but we paid $24.85 for the spread. And so our gain will be $75,000, $75,150 on 10 contracts. Again, this max gain occurs if the stock is at or below that lower strike price, and which in this case is 100. And then the break-even price is just going to be that top strike price, 200, subtracting the net debit or the net premium that you had to pay. So 200 minus 24.85 equals 175.15. If Tesla's right at 175.15, if the underlying stock is there, then we're sort of at our break-even price. That's the basics of the bear put spread. Let's take a look at this on Thinkorswim. So again, here I'm buying 10 of the June 200 puts, and I'm selling 10 of the 100 puts, basically giving away profits if the stock is below 100. But I will maximize my profits if the stock is right at 100 at expiration. Now let's take a look at the Greeks here and compare them to if we were just buying the outright put. So let's just pretend, let's go straight to there and pretend that we are buying the 200 puts. So we're just long naked puts. Now the delta is obviously negative, as we'd expect, $315 roughly. Delta is negative because puts make money when the stock goes down. So for every point that Tesla goes down, you'll make $315 in this case. This is a fairly gamma neutral trade. You can see the gamma is very close to zero for this naked long put. The theta is $61, $62. We're losing that much every single day to time decay, to theta decay. The vega is $707. So you can see that when you're long a naked put, there's quite a bit of you have quite a bit of volatility exposure. If implied vol moves up or down a point here, we'll make or lose $707. So if implied volatility increases by a point, by 1 percentage point, we'll make our profits will increase by $707. So again, we can sort of see what the time decay is here, what the delta is, and what the volatility exposure is. Now let's add in that short put. Now the nice thing about adding a short put is the short put is going to have time decay as well, and that time decay is going to work in our favor because we are short the put. So we can see right now with the naked long 200 put, our theta is about $62 a day. Now let's see what happens when we add that 100 put. Our theta is halved, down approximately halved, down to just $30 a day. So you can see the nice thing about this is that you are still subject to time decay as you would be with a long put, but it's not quite as bad. And as the options lose money due to time decay, the 100 put is decaying as well. And so what can often happen is this 100 put can decay and be maybe even expire worthless. If, for example, if we were to do a different month, we could change this to January 2020. Maybe that put would expire completely worthless, that short put, and then we'd just be long the 200 put, and we would have sort of funded what we were doing here. But so you can see adding that short 100 put, let's go back here, it will decrease our delta. So our delta with just the long 200 put was 315. It drops to 250. So we get a little less delta, a little less bang for our buck. Gamma is still basically near zero, gamma neutral. We already mentioned that the theta decay is halved. It goes from 61 or 62 down to 30, 31. And so time decay it's a little less painful to be long a put spread or to buy a bear put spread. That theta decay doesn't hurt you quite as bad because you're short an option that's time decaying as well. And then we can see the vega of the long put. You also have quite a bit of volatility exposure when you're just long a put. The vega here is 707, but when we add that lower leg, that lower strike, the vega drops down to 456. And so you're not quite as exposed to big movements up and down in implied volatility. So that's basically how you can modify. If you're thinking of buying puts on a stock, you should always think of what would a put spread look like, and what would the theta decay look like, and the sort of the risk reward. And again, we can take a look here and see. Obviously, our max loss is going to occur if the stock is above 200 at expiration. And that max loss will be $24,850. And then our max gain will occur if the stock is at or below 100. And that max gain, again, will be $75,150. And that will occur whether the stock's at 100 or 90 or 80 at expiration. Our profits are capped right there at 100. That's the basics of a bear put spread. In the next lecture, I want to take a look at a bull put spread.